Hey everyone, so in today's video, we're going to be going through an example of a capital gain when it comes to selling an investment property. Because heaps of people have been asking me, and I thought we'll just run through an example. Oops. So first thing, there are a few assumptions. Firstly, the taxpayer is an Australian tax resident. They've owned the property for more than 12 months. The ownership is in their personal name, so not in a trust, company, or partnership or anything like that. The purchase is done by an investor, not an owner-occupier. And just for the purposes of keeping the example simple, we won't include depreciation, so we'll assume the property is older. So firstly, the buy price. This is the purchase price the purchaser paid, plus the stamp duty, plus the legal and professional fees, like building and pest. So this gives you the total cost of $677,000. So that is your total cost base. So that's how much it actually costs for you to acquire the property. Now, let's say you have sold that same property 3 years later for a price of 750 grand. You've paid a real estate agent 20 grand to sell it for you. Plus, you've incurred another $3,000 worth of legal and other professional fees. This gives you a total net gain of $727,000. So that is the 750 less the agent fees, less the professional fees, which will give you the total sold or the net sold price of 727. So now, when we calculate the actual capital gain, we look at the total buy price, which equals the cost base, which included the purchase price, the stamp duty, and the professional fees, resulting in a $677,000 total. When we sold the property, this was the price received by the vendor, less the agent fees and the legal fees. So now if we subtract 727 from 677, that gives you a total net gain of $50,000. Because the property now was kept for more than 12 months, and the resident is an Australian tax resident, they get a CGT discount, which is a capital gains discount of 50%. So effectively, the $50,000 gain is divided by 2, or a $25,000 reduction. This will give you a total capital gain of $25,000. So now the $25,000 gets inserted into the individual's personal income tax return and gets taxed at the tax rate of that individual. So say, for example, someone is on 120,000, their personal income tax rate is 39.5%, including the Medicare levy as well. So the 25,000 would then be multiplied by 39.5%, so effectively 40%. So out of this 25 grand, 40% would be $10,000 effectively. So that in a nutshell is how we work out the capital gain when it comes to selling an investment property, assuming that all of those prerequisites are met or those requirements are met. For example, the Australian tax resident, the ownership of more than 12 months, and what was the last one? And it was an investor purchase. If you have any questions on how this calculation is done, feel free to reach out and hit us up. Thanks.
Thanks.